Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Stock markets have been able to shrug off multiple layers of risk over the last weeks to sit in sort of the all-time highs range. Our next guest says we have been witnessing some momentum, which usually begets more momentum. Is this the case still in today's markets throughout this week and the weeks ahead? And how can investors evaluate which signals will inform us about caution and which signals may help drive equities higher? On a macro level, can US growth peak out and pass from behind the certain debt drag that has been signed into law via the Big Beautiful Bill? Joining us with his research to help you wade through some of the slightly foggy but potentially bullish pictures out there is Fidelity's head of global macro, Jurrien Timmer, back in Boston. Great to see you. How are you?
Nice to see you. Yes, back in the US after a 2-week, 5-country roadshow throughout Europe with one carry-on piece of luggage.
Oh my goodness gracious. Yeah, you'll be have some new clothes to change into. Well, we're delighted to see you. It's probably a bit steamy warm. It is on the East Coast generally, isn't it?
Yes. Yes, it is. Very much so.
Yeah, don't want to complain about the heat though. Let's talk about actually what's going on with the Federal Reserve, because we're talking about what can be sustained and in reaction to this big, beautiful bill. But this seems to have come pretty quickly on the heels of that bill being signed into action.
Yes, so we had the big, beautiful bill passed last week. $5 trillion of new spending and $5 trillion added to the debt ceiling. And, you know, the government, not to sound political here, but the pressure on the Fed right now, which is becoming more and more loud, is really kind of a dangerous game because, you know, the Fed is obviously independent. The status of the dollar, the safe haven of treasuries is all basically maintained by the Fed's independence as the world's, you know, primary central bank, if you will. And so the Fed can and should engage in monetary policy based on its dual mandate of, you know, inflation targets and full employment, and the notion that it should cut rates to the level of Switzerland, where I was just at 2 weeks ago, is sort of silly, right? Switzerland is cut rates to zero because the Swiss franc is way too strong for their liking. No country really wants a strong currency, and so they're trying to battle that and make it as unappealing for foreign investors to invest in the Swiss franc, which is the opposite problem that the U.S. has, where the dollar actually continues to make new lows, where dollar index is about 97 today. So, you know, and actually we can pull up slide 8 here. So in terms of where the Fed's at, I think the Fed, you know, during the 60s and early 70s, it made a very famous policy error by being too loose at a time when fiscal policy was also very loose for a very long time. These were the guns and butter days, and of course we're back there again now. You know, since COVID, we've had nothing but deficits here, and so the Fed, I think, is trying to lean into the fiscal side a little bit. It made another policy mistake, in my view, back in 2021. By not removing the accommodation quickly enough, fast enough, because it underestimated the fiscal impulse that happened, you know, during COVID. That was another $5 trillion helicopter drop. Now we have the second one. So I think the Fed's doing the right thing. It's just on the high side of neutral. So if neutral is 2.5% inflation or 3% inflation plus 100 basis points, so you get 3.5 to 4. As a neutral rate, the Fed's at 4 3/8. So there's a couple of rate cuts there that are justified and that the Fed itself is saying it will do, and the markets also think it will do. So there's no controversy there. But if it did anything more than that, it would be down. You know, it would be going well into the accommodative mode. And with unemployment at 4.1 and inflation at 2.5 to 3, sticky at those levels and still above the Fed's target, there really is no justification whatsoever for the Fed to go to like 3 or 2 or something like that. And so, you know, government officials who are calling for that I think they're playing a dangerous game because they may miss where Treasury yields are currently and where the dollar is if they challenge the Fed's credibility and independence too much.
Just going back to the guns and butter stage, what was the result of letting up too early?
So back in '66, not to get too specific, so back then, I think policy was still traumatized by the Great Depression, of course, World War II, even though this was several decades later. But other than the inflation during World War II, which clearly was transitory, that was just, price controls being lifted and all that pent-up demand for raw materials finally, being reflected in price levels. Other than that period, there really was no inflation since the 1920s. And so the Fed didn't really even think about real rates. Like it was, the Fed is not the Fed that it is today. And so that, and because the world was now leaving the gold standard or was about to leave the gold standard, the fiscal spending was, becoming very pronounced. There was a big emphasis on full employment and fiscal expansion. And so that's a pretty potent combination, loose monetary plus loose fiscal. That's going to create inflation, and it did. And the Fed back in '66, they loosened rates too soon when there was a blip in the economy, and then inflation was already growing, and then they had to take it back. And then of course during the '70s we had the oil shock, which it was an out of the blue thing, and then we got that great inflation. So the Fed, I think, is still haunted by that, and maybe realizes that back in '21 they kind of repeated that mistake a little bit, and I think they're pretty determined not to do that a third time. And I think that's why they're staying just on the other side of neutral while they wait to see if these tariffs, whatever the tariffs are that we end up getting or not getting, how inflationary those are going to be.
Yeah. And just for some clarity on that, it does seem like the overall tenor of it has come down a little bit, but the specifics, as you say. So along with, I hope you had a good holiday if you celebrated on Friday and so on, but that was also the end of a quarter, month end. We kind of come back to the basics. We expect earnings to come through ultimately. What are you looking at in the markets right now to drive? There's a lot of headline risk always, but we do come back to sort of the earnings story, don't we?
Yeah, so let's start with slide 3, a chart that we show often. Again, you can deconstruct the market's return into its components: dividends, earnings growth, changes in valuation. You look at the yellow kind of trend there on the top. The market is in an uptrend, as it generally is. It's well above the trend line. It's at new highs, as you mentioned earlier. You look at the composition, right? So earnings growth is positive. It's less positive than it was. It looks like the peak was at 10%. We're now at about 7 or 8%, which is historically in line with the average. And the valuation side, which had contributed a lot to the return in 2023 and in 2024, right now is sort of neither here nor there. Obviously, valuations came way down in April when the market was down 21%. It has now rebounded, so the forward PE has completely round-tripped from 23 to 18 back to 23. And so the question is, looking at that yellow shading in the top, is, do you want to own that chart, right? And I don't mean the chart. It's like as an
That's
NFT.
your chart.
But do you want to be long that chart? And normally you would say yes, of course, because the trend line is rising. You're at new highs. You're above the trend line, and then that could mean it's overbought. But it also means it has momentum, and momentum, like you said, often begets more momentum. But the question is that what is the price that you're paying for those earnings? And if we go to slide 7, I've got kind of the same chart, but now with the PE ratio in the bottom, you're again back in the upper decile or so of valuation. And so, yes, you want to be long the chart, but at what price, right? And this is the difference between price and value. Price is what you pay, value is what you get. And so you are, if you're getting in at this point, you are paying a lot for every dollar of earnings. And that's not necessarily the worst thing. I mean, we do have the big, beautiful bill. There is a very expansionary part to that, not only from the taxes side, but also in terms of the capex. So the depreciation rules are very generous, more so than we saw back in 2017 during the TCJA. But it produces more, it increases the onus on earnings to come through. And so if we go to slide 4, earnings season is coming up next week or so. And what we did see back in April during that tariff tantrum is that the earnings estimates were cut quite a bit.
They were
not
kind
to
of
levels
thrown out. They were kind of chucked out, weren't they?
Yeah. So going into the year, the expected earnings growth for 2025 was 12.4%. That got cut to about 7%, which is still positive. It's on average. So it's not like the market over discounted a left tail, like, negative growth. It didn't do any of that, but it discounted a slowdown. And so now we're going into earnings season with a 2.8% expected growth rate for the second quarter earnings versus a year ago. And those levels have been fairly flat in recent weeks, which makes sense because the tariff stuff has been put on hold. My sense is that there is some upside potential here. If you look at slide 5, you can see that the revisions in earnings tend to be correlated to financial conditions. So animal spirits in the markets will make CEOs more confident about earnings. And so financial conditions have loosened. It's at 99. This is the Goldman Financial Conditions Index. And earnings revisions were down 12%. And so there is some room for recovery there. And then if we go to slide 6, you can see a similar pattern where when the dollar goes down, so this is the blue line is the rate of change for the dollar index on a reverse scale. And so the dollar is down 8% year over year, and that tends to be a tailwind as well. And of course, you all know this in Canada, that if your currency is weaker and you're exporting, that translates into better earnings. And of course, the US it has a lot of very big global companies that get their revenues from abroad. So between financial conditions and the dollar and the fact that earnings growth did get haircut without there being the tariff shock at this point, and that could change, of course. And then on top of that, the big, beautiful bill, you could see the scenario where earnings growth maybe reaccelerates, and maybe that's why the PE is high, because it's anticipating that. So again, maybe it all makes perfect sense, but things do have to go right in order for that to materialize.
There was something that you were mentioning in some research about, 2 years ago, we were sort of waiting for breadth to take over. That was sort of the story. Do you take a look at just the top stocks, the top 10, top 7? What about the rest of the S&P 500? There is a bit of a breadth story again, sort of waiting for that piece to come back. A lot of the other market did, tied to sort of the tech stars. But tell us what you're seeing in breadth. And I wonder if it's a comment on the economy.
Yeah, so if we go to slide 2, this is a monthly chart through June. And it shows, again, that uptrend line that I showed earlier. The pink one is a very long-term one. The yellow one is the secular bull market, at least the way I define it, since 2009. Again, trend-wise, everything looks pretty good. But you look at the breadth, 57% are above their 200-day moving average. It's not terrible, but it's certainly not great, especially coming off of a 20% decline and then the bounce. And it's remains a selective market. It is broader than the Mag 7. You can see with the big, beautiful bill, the banks have done very well. Industrials, of course, plays on this kind of industrial policy and a steepening yield curve. So it is more than the Mag 7, but there are still a lot of sectors that are sort of not participating. And the S&P equal weighted index, which I don't show here, is still below its highs, as well as the Russell 2000. So it is still a sort of a big cap, growthy dominated market, but with participation from industrials and financials. So, we're in year 3 of a bull market. A few months ago, I said the bull market's probably over. That was a little premature, I think, because we are at new highs. But even if it's not over, I think we're still in relatively late cycle innings, and that is when you would see breadth, not be as robust as it would be in the early phases of a bull market.
Yeah, no, it's the question of valuations, which you've gone through there, and just how expensive ultimately equities are right now. That said, when you take a look at sort of the 60-40, it still seems to be a pretty good place to be based on how the other side of the ledger is doing.
Yes, and that comes back to a conversation that we've had in the past, and conversation that I've had with a lot of CIOs and treasurers and portfolio managers when I was just doing the tour in Europe. The 60-40, maybe it's dead, maybe it's a 60-20-20, as we've talked about, and gold, I think, plays a big role in that, and we can talk about that gold is really returning as a pretty big reserve asset around the world. And then maybe some alternatives, liquid alts, maybe some Bitcoin, some cash, which actually is competitive in a bear steepening yield curve. But the 60 is still the anchor, right? And we're fortunate that while the U.S. is expensive, again, you look at a CAPE ratio, top decile. The same is not true for the rest of the world, and I'll have some good charts on this next week, by the way. So there is a fair amount of low-hanging fruit, at least in terms of alternatives to U.S. equities. There's no slam dunk asset, and we were talking before the show, but the conversations I had in Europe, again with these sort of high-level institutional investors, were like, okay, we understand maybe the dollar becomes less hegemonic and loses some of its supremacy premium, but where are we supposed to go? Europe is sort of like, Japan is, grows very slowly or not at all. EM has different issues. And so there is not a very obvious alternative, but in Europe and Japan, you can buy stocks that maybe are not going to grow as fast as the tech companies in the U.S., but they have pretty good yields, and it becomes maybe more of a game of income rather than capital gains in the stock market. But that 60, I think, is still solid, but maybe it's a much more global 60 than what we in the U.S. have had the luxury of having the last 15 years, where you just had to own the S&P. So I think the composition of 60 changes, and then you get to the 40, and the 10-year Treasury is back at 439, and if the bond vigilantes wake up, we could be at 4.5, 5 again, especially if this attack on Powell at the Fed continues, and that can be problematic as well. And so in that sense, bonds can affect the stock market while bonds themselves are going up in yield, and so that 40 is somewhat at risk there, and that's why I think one of the reasons why gold has done so well with Bitcoin right on its heels.
Yeah, fascinating. There's some great questions rolling in. Kind of circling back to what you started with, what are your thoughts on the potential implications of the recently signed U.S. tax bill? Maybe go to sort of the tax story itself, and if you want other parts of it, but just to dig into it a little bit.
Yeah, so the personal tax rates were extended. So the 2017 tax cuts were going to sunset this year, so they're not sunsetting. And the corporate taxes, of course, did change. And but more important than that is the depreciation. So you can depreciate basically all your expenses or all your capital expenses fully right away, and so that should unleash somewhat of a capex boom or boomlet, and that's what we need, right? We need productivity to go up, and we got the AI story. So I think that's a good thing, and so that could boost earnings and it could boost profit margins. And again, then it's a question of how much does that get offset by tariffs if there are more chapters in the tariff story, which we don't know. And then on the other side, how much of that gets offset's not the right word, but that gets mitigated by rising term premia and rising yields. Sure. And that gets you back into the fiscal story and the status of the dollar, and the cost to have all this debt service, which is I think about 1.2 trillion. And actually, let's pull up slide 13 here, which kind of shows in a nutshell, I think that the math challenge that many parts of the world have, but the U.S. was always kind of immune from. That brings me to my, cleanest dirty shirt, comparison. So the U.S. was always the cleanest dirty shirt because if you look at this chart, you see the blue line is the 5-year change in potential GDP growth. Obviously, the bars is the 10-year yield. And the math is that when you have a lot of debt, you need to outgrow it unless you're going to cut the debt or go into default or something, which is not going to happen here. So as long as your growth rate is above your cost of funding, your debt is sustainable, and it largely has. And during times when bond yields were above the growth rate, the debt was not really an issue, so it didn't matter. So we're at a point now where growth is above the 10-year yield, which is good. So the debt is still considered sustainable. But if you look at that blue line using the CBO's potential GDP growth rates going forwards, this is nominal growth, that number goes down to 4%. And if you assume for a moment, as I've done with my bond model, which is the green shading, that the term premium, which is now around 60 basis points, goes up to 150 basis points, which would be historically more a fairly normal level, then you can see that your funding rate then goes above your potential GDP growth rate. And that's when you have a problem. And that's when the bond market starts to act up. That's when the dollar really goes down. And at that point, you either need to cut the debt or grow even faster or get the Fed back involved, which I think is what part of this debate is already about, where I think the administration wants to put a friendlier Fed person in place that can help sort of do the yield curve control that the Fed did back in the 1940s and the Bank of Japan has done more recently. But again, it's a dangerous game when you have the dominant reserve currency because you can control rates all you want, but as the Bank of Japan learned recently, you can't control everything. So if you control rates, you can't control the currency, and so that's kind of those are some of the tails here that we're looking at. But if we go to slide 12 for a real quick second, yes. It shows the term premium, and you can see that it's been negative the last couple of decades because of financial repression, the Fed, other central banks buying up the safe assets, suppressing the term premium. But that's not how it normally is, right? It's like a beach ball that you hold underwater. It doesn't want to be negative. It makes no sense for a risk premium to ever be negative. And so a more normal level is a positive level, whether it's 100 or 200 basis points, we don't know. But you're seeing that return to normal. And if that continues, then we're going to be, we could be at 5% and not a lot of good things happen at those levels.
The questions that you were getting, you're in your travels in Canada, but also across the pond. Were people talking about whether international money was to be put to work within the US Treasury market? Okay, yes, the US currency as a reserve, which often is expressed through owning treasuries. But was it all connected, or was it just?
It's connected. So the CIOs I talked to were mostly invested in the U.S. via the equity market. And for instance, like in Switzerland, which just cut rates to zero, if you are buying U.S. bonds and you're a Swiss investor, and you want to hedge the currency, like the math doesn't work because
Right.
rates in Switzerland are so much lower than in the US. So there was not a big angle for them to be in treasuries, and also European yields have become much more competitive. The U.S. is trading below France and Italy, which is, that tells you something perhaps. And German yields have come up, Japanese yields have come up. So it's mostly a question of, does the Mag 7 machine still work? What happens to the dollar? Is the loss in the dollar as from a currency translation point of view, is that going to be enough to alter the relative performance of the U.S. versus Europe, for instance? And those are hard questions to answer. But it was probably more of a philosophical question about the status of the dollar, what the U.S. is doing in terms of trying to upend the global world order. And of course in Europe and in Canada, you can imagine there's a similar sentiment of, basically it's like, why are they doing this to us? We're just here minding our own business. And one of the questions I kept getting was, how do people in the U.S. think about this? Because in Europe, everyone is sort of in fair agreement, a fairly broad agreement about what's going on. And I told him, well, in the U.S., it's just as divided as anywhere else. So there's it's a very unique point in our history.
Yeah, no, it's fascinating how this is all ultimately going to come together. The cut too early question, though, I mean, it now looks, because of some headlines that are being made today and probably through this week, that July, I mean, does July get any more live under Jay Powell, or are we looking at something bigger? I mean, can he be pushed, I guess, is the question.
Yeah, actually, I'm just pulling up Bloomberg here. So it's really, you're looking at the first full cut is expected somewhere in September, October.
Yeah.
And so the jobs report on Thursday, was sort of the final nail in the coffin against a July cut, right? And if you think about it, we can go to slide 9 here. If you look at it through the lens of the Taylor rule, which is an algorithm that John Taylor back in the late 90s developed at the Fed that says, okay, policy is a neutral rate, R star, plus a differential coming from the inflation side, plus a differential coming from the growth side. And if neutral is 100 basis points and inflation is above target, which it is, not by as much as it used to be, but still a good 0.5%, if not more. And now the jobless rate as of Thursday is back to 4.1, which is well below what's considered full employment. And so if you look at various iterations of the Taylor rule, which I show in the top of the chart here, they really have been going sideways now for at least 6 months. And so the Taylor rule was correct in saying the Fed should return from restrictive to more neutral. But it's not making any further progress in that direction, because you would need the unemployment rate to go up and or the inflation rate to come down for the Taylor rule to kind of justify more rate cuts. So the Fed is, like I said, on the high side of neutral. It can go to 3 3/4, no problem. The economy is not going to feel that. Even the Treasury financing, with all the T-bills, I don't know that really moves the needle that much. So I'm sure it would help a little bit. But if the Fed moves too quickly, it runs the risk that the markets, cries foul, and the bond vigilantes wake up, and the yield curve just bear steepens. So there's no free lunch, right? The Fed can't go to 3 or 2 or 1 without any consequences. The consequences would come from the yield curve and the shape of it, and then the Fed would have to go in and control the yield curve, and then it would come out of the dollar. And so, again, it's a dangerous game attacking the Fed's independence like this when there really is no justification. If the Fed was making a severe policy error, then okay, fine, all bets are off. But it's not. It's doing exactly the right thing.
I wonder if there's just sort of 30 seconds in here. Within the trade story, it does seem like things are going to move slower with China. What does that indicate to you about this, that the economies are actually more entwined than you think, the US and China? Like, they can't be separated in the same way.
No, it takes time, right? You need to rebuild supply chains, and that takes time. It costs a lot of money. It could be inflationary. Globalization was a very well-oiled machine. It had consequences, like you'd look at the middle class in the States and the manufacturing jobs being lost, but those jobs aren't necessarily coming back. Robots would do those jobs, and in many ways, the manufacturing job conversation is the same conversation we had a century ago about agriculture. I mean, those jobs get lost to automation or they get arbitraged away, and so the global economy is really closely connected, and you can't just unconnect it overnight. And I think that was one of the lessons back in April, and that's what the markets were saying.
Yeah, it's fascinating watching the markets traverse through this. We'll look forward to being in touch with you next week. Thank you so much for clarifying some of these pieces for us. Jurrien Timmer, great to see you.
Thank you very much.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.